Hello, welcome to Tax Talk for Women. I'm your host and presenter, Kay Willie, taxpayer defense attorney, CPA, wife, and mother. Today we're going to talk about some really basic tax concepts. And I know you're probably thinking, I don't want to listen to this. But these are terms that people use all the time. They use them almost interchangeably, and they do not know what they mean. I'm talking specifically about deductions, exclusions, and tax credits. Most people do not realize that there are real differences between these three things, and that is what I am going to talk about today. Deductions are subtracted from taxable income, and they reduce the amount of your income that is taxed. Now, for the federal level, there are two types of deductions. Below-the-line deductions, otherwise known as itemized deductions, and above-the-line deductions. And don't ask me about the line, it no longer exists, but we still refer to these things as above the line and below the line. Okay, below the line deductions are reported on Schedule A of your 1040 return. They reduce federal taxable income only. They have no effect on your taxable income for state tax purposes. Some very common examples of itemized deductions, below the line deductions, are mortgage interest, state and local taxes, and charitable donations. Now, above the line deductions are reported on Schedule 1 of your 1040. Now, these deductions generally have the effect of reducing both federal and state taxable income. Some common examples of above-the-line deductions include IRA contributions. Now, these are traditional contributions only, not Roth. Moving expenses for active duty military, they're the only guys that are allowed to take this deduction anymore. And alimony payments for people who have a pre-2019 divorce or separation agreement. Now, the next term we're going to talk about is exclusions. Exclusions are items that are excluded from federal taxable income by law. Okay, these are enumerated in certain specific sections of the Internal Revenue Code. Exclusions generally will reduce both federal and state taxable income. Some common examples of exclusions, perhaps the best known is life insurance proceeds, certain scholarships and fellowship grants, but only to the extent that they cover qualified educational expenses, foster care payments, and child support payments. Now, we get to my favorite item, which is the tax credit. A tax credit does not reduce your taxable income. It actually reduces, dollar for dollar, the amount of tax that you owe. Federal tax credits reduce federal tax. State tax credits reduce state tax. Now, I have here a numerical example that hopefully will drive this point home. Let's assume that you have a federal tax rate of 20%. Let's assume that your state tax rate is 5%. I tried to keep the numbers simple, not necessarily realistic. All right, let's talk about what is the value of a $5,000 itemized deduction, a $5,000 exclusion, and a $5,000 tax credit. I have here a numerical example of the value of a $5,000 itemized deduction. That is $5,000 times 20% is $1,000. So a $5,000 itemized deduction has an actual value of $1,000. Now let's look at a $5,000 income tax exclusion. Now you multiply the $5,000 by 25%. That's your combined federal and state tax rate, and that comes to a total of $1,250. And finally, the value of a $5,000 tax credit is $5,000 times 100% equals $5,000. So keep this in mind. The next time you're talking to your tax advisor or you hear a talking head on some financial program on TV, they're talking about deductions, they're talking about exclusions, they're talking about tax credits. Now you know what the difference is between these two items, and you understand why credits are so much more exciting. That's all for today, folks. I hope you enjoyed this. I'll see you next time. Bye-bye.